Welcome to Brickwork Ratings Knowledge Library series. In this video, we will be learning about credit default swap. What is credit default swap? A credit default swap is a contract between two parties where a party purchases protection from another party against losses from the default of a borrower for a defined period of time. The buyer of a CDS makes periodic payment to the seller till the credit maturity date. In the agreement, the seller commits that if the debt issuer defaults, the seller will pay all the premiums to the buyer and the interest that would have been paid up to the date of maturity. Credit default swaps came into existence in 1994 when they were invented by Blithmasters from JP Morgan. CDS was bought for leveraging portfolios, hedging, arbitration, and speculation. For example, X lends Rs 10,000 to Y at 10% for 5 years. X also bears the risk of non-payment by Y. So, to shift the credit risk, X buys a CDS from Z. Z, in return, charges a premium of Rs 100 per annum. Now, in case of default, Z is liable to pay the full principal amount and the interest. In case of no default, Z will end up making a profit of Rs 100 per annum. Advantages of CDS. CDS protect lenders against credit risk. No underlying asset exposure. Enhances portfolio yields. Boost economic growth. Disadvantages of CDS. These are traded over the counter and not well regulated. CDS sellers inherit significant risks. It also gave a false sense of security to investors. How credit default swap caused the 2008 financial crisis. In the United States, by mid-2007, there was more than $45 trillion invested in credit default swaps. This amount was more than the money invested in the US stocks, mortgages, and US treasuries combined. Lehman Brothers had a significant role in the cause of this crisis. As a firm, they owed $600 billion in debt, of which $400 billion was covered by credit default swaps. When the debt was eventually due, Lehman Brothers couldn't cover the cost, so they declared bankruptcy. This caused further issue as the companies that sold the swaps didn't have enough cash to cover the contracts. This led to the collapse of the CDS market and eventually triggered the 2008 financial crisis. Do like, share, and subscribe to Brickwork Ratings channel.